Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Berkshire Hathaway.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So Warren Buffett is gone, and he left behind this just incomprehensible pile of cash.
Yeah, $397 billion.
Right, which is just staggering. And today, we have to figure out if that mountain of money is, a fortress protecting your portfolio or just this massive inefficient trap.
Because it is Q1 2026, and the entire financial world is watching this paradigm shift.
Exactly. Everyone is assessing Greg Abel's performance in his first quarter, navigating this whole thing without the legendary architect at the helm.
And the market is frankly kind of choking on that metric. $397 billion in cash. It fundamentally alters the thesis.
How so? Like mathematically?
Well, when you have nearly $400 billion in liquidity, you aren't just a participant in the market anymore. You are the buyer of last resort.
Right.
But, to really understand what Abel is doing with all that capital, we have to kind of strip away the emotional overhang of the transition.
We have to look at the actual structural mechanics of the business he's managing now. All right, let's move into the wealth building context.
Right. So if you are constructing a long-term portfolio, your primary objective, alongside compounding, is survival.
Surviving severe macroeconomic stress.
Exactly. And in that specific framework, this company acts as the ultimate fortress stock. Because of that massive cash position, they are structurally designed to capitalize on panic.
So when liquidity dries up, or credit markets freeze.
Yeah, when highly leveraged operators are forced into fire sales, this conglomerate is literally the only entity capable of stepping in.
To scoop up those distressed, high-quality assets at really favorable terms.
You got it. That is a structural mathematical advantage. It doesn't just vanish because a new CEO took the corner office.
I understand the structural argument. Okay. I really do. But you cannot just hand-wave away the psychological reality of this transition.
Sure, the psychology plays a part.
A huge part. For decades, investors willingly paid a massive Buffett premium. You bought the stock because you implicitly trusted his singular genius.
Right, to allocate capital better than anyone else.
Exactly. So with him completely out of the picture, my caution here is that this premium is naturally eroding. The market is going to demand a tighter valuation multiple.
Because they want proof now, not just faith.
Yes. Multiple compression is a very real threat to long-term wealth building for current shareholders.
Well, the erosion of that premium is a given, but you have to look at the actual math protecting your downside right now.
Okay, what math?
The margin of safety is already baked into the current valuation. First, that immense cash hoard acts as a physical shock absorber against valuation compression.
Yeah.
But more importantly, look at the underlying equity portfolio. It's currently trading at an average price-to-earnings ratio of just 10.
Wow, only 10.
Yeah. That is an incredibly cheap multiple compared to the broader S&P 500. So you're effectively buying a basket of highly profitable, cash-flowing businesses at a severe discount.
All housed inside that fortress balance sheet.
Right. And that setup protects and compounds your capital independently of the specific personality managing it.
Now let's look at the fundamentals.
So to see if that fortress is actually holding up under Abel's execution, the Q1 2026 operating numbers are really the most critical data set we have.
And what are we seeing there?
We're seeing a massive inflection point. Operating earnings surged 17.7% year over year.
Hitting $11.346 billion, right?
Exactly. And you have to contextualize this. Back in Q4 of 2025, operating earnings took a nasty, highly publicized dip. They fell almost 30%.
Oh, man. Yeah. The market was incredibly nervous about that.
Very. So to see this sharp, nearly 18% acceleration right after that dip, it proves the core operating engine is fundamentally sound. It's re-engaging under the new leadership.
But what specifically is driving that re-engagement? A conglomerate of this immense size Doesn't just flip a switch and reverse a 30% decline.
Well, the growth drivers this quarter were really concentrated in their heaviest economic pillars. The insurance underwriting segment jumped a massive 28.5%.
That's bringing in over $1.7 billion, I think.
Yeah, and that's the direct result of aggressive pricing normalization making its way through the book. Then you have the BNSF railway division,
Which grew 13.4%.
Right, those are robust, double-digit growth figures in mature, capital-intensive industries.
Okay, the operating rebound is solid. But I have to stop you there, because the balance sheet mechanics are where my analytical red flags are just waving aggressively.
Oh, how so?
That record, $397 billion in cash, didn't just grow organically from operations. It was heavily fueled by $8.1 billion in net equity sales during the quarter.
They are actively liquidating parts of their stock portfolio, yes.
Right. Meanwhile, the insurance float remains totally stable around $176 billion. So mathematically, isn't holding that much cash in short-term instruments just a massive drag on overall equity returns?
It creates a drag, sure.
I just don't understand how locking up that much capital is efficient. If you have an engine flooded with that much idle fuel, your return on equity gets completely diluted.
Well, you're looking at the drag, but you have to measure that against the strategic optionality Greg Abel is executing.
What's the strategy then?
Management clearly recognizes the exact inefficiency you're pointing out, and they are addressing it. By officially resuming share buybacks in Q1, they purchased $234 million of their own stock after a year-long pause.
Oh, interesting.
Yeah, when a management culture known for ruthless capital discipline starts buying back its own shares, it's a glaring signal. Their internal models show the current market price is well below intrinsic value.
Buying back shares below intrinsic value is mathematically sound, I'll give you that. It actively increases the ownership stake for every remaining shareholder without them lifting a finger.
Exactly.
And it clearly helps the underlying metrics. I mean, we saw the book value per Class A share climb 10.5% by the end of 2025. So the asset base is compounding.
Right. They are systematically growing the pie while simultaneously reducing the number of slices available in the public market.
That brings us to the catalyst timeline.
With that much capital sitting idle, the market is aggressively looking for specific events over the next 3 months that will force a repricing.
The first milestone is obviously the Q2 2026 earnings report coming in early August.
Yes, and the spotlight there is going to be intensely focused on the BNSF railway. Institutional investors need to see if BNSF can maintain those operating ratio improvements.
Or if it was just a temporary blip.
Yeah.
Because railways are incredibly unforgiving businesses. Any slight deterioration in their operating ratio can wipe out profit margins instantly.
Absolutely. But looking beyond the internal rail operations, the broader macro environment is a massive factor for a balance sheet of this size.
And how is that shaping up?
That macro setup is currently a tremendous tailwind. We are firmly entrenched in a higher for longer interest rate regime.
Right, which usually hurts companies.
It destroys highly leveraged tech companies or aggressive real estate operators.
Yeah.
But it is a massive asset here. They are earning a huge yield on that short-term treasury portfolio.
Right, earning around 5% risk-free on nearly $400 billion.
Exactly. You're generating an incredible stream of baseline income just for sitting on your hands. Think of that cash pile as an insurance deductible for the broader economy.
It pays a steady yield now, and if rates trigger a severe economic slowdown, they have the dry powder to step in and acquire distressed assets at bargain prices.
Precisely.
Which perfectly leads into the speculative catalyst that is driving all the back-channel chatter right now.
Ah, the elephant gun.
Yes. With $397 billion ready to deploy, the pressure on Greg Abel is immense. The market is anxiously watching for his first elephant-sized acquisition.
It's what everyone is waiting for.
Because this isn't just about corporate expansion. This is about legacy construction. An acquisition of that magnitude would definitively prove his capital allocation prowess.
He has to show he can deploy a massive chunk of that cash at their critical 7% or higher return threshold.
And until he pulls the trigger on a major deal, that cash pile is going to continue causing the drag on returns we discussed earlier.
The market desperately wants to see that major deal. But, Abel's mandate isn't to buy just for the sake of spending cash. His mandate is to maintain the discipline that built the fortress in the first place.
Now let's pivot to the chart.
Because when you look at the fundamental strength, the 18% operating earnings rebound, and that incredible cash optionality,
the stock's actual price action is telling a completely different surprisingly subdued story.
It really is.
If you are holding this stock right now, you are probably feeling a lot of frustration. You are looking at the S&P 500 pushing higher, while your shares are actually down 5.9% year-to-date.
Yeah, as of the Q1 release.
The underperformance is glaring. And if you zoom out to a one-year time frame, the stock is down roughly 12% from its peak.
Which is painful for holders.
It's exactly the symptom of the transition anxiety we talked about. Investors are sitting on their hands waiting for proof that the new regime can actually drive the ship.
That frustration is completely understandable, but for a patient, long-term capital allocator, that price action is precisely the opportunity.
Why is that?
Because the stock has lagged so severely, it's now consolidating near the lower end of its historical valuation range. It's trading right around 1.4 times book value. Historically, whenever the specific company approaches that 1.4 times valuation floor, it has represented an incredibly attractive, low-risk entry point.
So you're getting access to all of that operating growth without having to pay a premium multiple.
Exactly.
And we are seeing a crucial momentum shift right now that actively supports that floor. The flow of capital is reversing.
Right, with the buybacks.
Yeah. For quite a while, with the $8.1 billion in net sales, the company was a net seller. But the sudden resumption of stock buybacks changes the technical landscape entirely.
It really does. When the company itself steps into the open market to buy its own shares, it creates a hard technical and psychological barrier against further downside.
It signals to short sellers and bearish institutional funds that there is a massive, incredibly disciplined buyer waiting to absorb volume at these price levels.
So what does market sentiment look like?
It is deeply conflicted. I mean, the chart is lagging because the market mood is a tug of war between the undeniably strong operating numbers and the lingering anxiety about the post-founder era.
Well, if you look at the insider sentiment, it is definitively bullish. And you really couldn't ask for a stronger, more culturally significant validation than what we just saw.
You mean the endorsement?
Yeah. Warren Buffett explicitly endorsed Greg Abel, going on the record to say that Abel is doing everything I did and then some.
That's huge.
For a corporate culture built entirely on trust and delegated autonomy, that public endorsement is the ultimate sentiment booster for the entrenched institutional base. It was the signal they needed to stay the course.
However, when you look at the broader analyst view, the sentiment gets significantly more grounded. Morningstar currently maintains a 3-star rating on the stock.
Right, with a $510 fair value estimate for the Class B shares.
Exactly. That indicates they view the stock as fairly valued, perhaps slightly undervalued, but certainly not a screaming deep discount bargain.
And on the more cautious side,
CFRA research is actively tempering the mood. They are specifically calling out the severe underperformance of GEICO as a fundamental reason to limit any multiple expansion right now.
it is entirely true that analysts are mixed. But you also have to pay attention to the structural signals coming from the new leadership.
Like what?
Well, Abel just made a major portfolio cleanup signal that flew under the radar for many retail investors. He completely sold off the equity portfolio that was previously managed by Todd Combs.
Wow.
Yeah, that is not a passive administrative move. It is a highly aggressive signal showing the new regime is decisively taking charge.
Streamlining operations.
Right, reshaping the overall portfolio to fit their specific forward-looking thesis. He is actively clearing the deck of legacy positions.
Now let's talk about the risks.
Because we have to understand exactly what fundamental threats are making analysts like CFRA nervous and actively keeping a lid on the stock's price momentum.
Well, the most immediate operational risk is definitively GEICO's massive stumble. We noted earlier that overall insurance underwriting grew, but underneath that headline number, GEICO is facing incredibly severe headwinds.
Right.
Their pre-tax underwriting earnings absolutely plummeted by 34 to 35% in Q1 2026.
That is a massive, glaring deterioration in profitability.
It is. And why is this happening? Because while their direct peers in the auto insurance industry are actively utilizing advanced telematics and improving their pricing models, GEICO is actively losing market share.
And they're struggling intensely with escalating loss costs. They are falling dangerously behind in a highly competitive, technologically driven sector.
The GEICO issue is an undeniable drag on earnings. Abel has a massive operational turnaround job to do there. But we also have to address the structural tail risk that is far more intimidating to institutional capital.
You're talking about the utilities division.
Right. The Pacific Core wildfire liability. This is the dark cloud hanging over the entire conglomerate right now. Berkshire Hathaway Energy currently faces an estimated $55 billion in wildfire claims related to PacifiCorp.
$55 billion. It's a staggering number.
Let me repeat that. $55 billion in estimated claims. To put that into perspective, their current settlements are only hovering around $2.2 billion.
So the gap between what has been settled and the total estimated liability is just a massive, unresolved financial crater.
Exactly. In states where inverse condemnation applies, utilities can be held strictly liable for damages regardless of negligence. For any normal company, a $55 billion liability is a guaranteed bankruptcy event.
It would wipe out the equity entirely.
Yes.
A $55 billion hit would instantly destroy almost any other publicly traded company. But this is exactly where the unique, decentralized structure of the conglomerate completely mitigates that worst-case scenario.
Also,
First, Abel isn't just sitting back waiting for the lawsuits to bankrupt the energy division. He is actively pursuing heavy legislative and regulatory changes in those specific states to cap utility liabilities moving forward.
okay, but what if those regulatory changes fail?
Even if we assume the absolute worst-case scenario mathematically and the judgments come down against them, you have to remember the $397 billion cash fortress.
Right.
They are literally one of the only entities on the planet that could fully absorb a catastrophic legal liability of that magnitude without bankrupting the broader enterprise.
The shock absorbers we discussed earlier.
Built precisely for black swan events like this. And regarding GEICO, yes, the numbers look terrible this quarter, but those issues are purely operational.
Meaning they can be fixed.
Over time, with aggressive management changes, better telematics adoption, and tighter underwriting adjustments, they are temporary headwinds, not existential threats to your accumulated wealth.
So with everything on the table, what's the final verdict?
When you mathematically weigh the $55 billion wildfire tail risks and the GEICO turnaround against the sheer scale of a $397 billion cash pile.
And that accelerating 18% core earnings growth rate.
Exactly. The math heavily favors the upside. The bullish score for this stock is an 8 out of 10. We are looking at a deeply asymmetric opportunity for patient capital.
So the market is just missing it.
The broader market is vastly over-discounting the erosion of the Buffett premium while completely ignoring Greg Abel's proven capital discipline and operational ruthlessness.
Right.
You have a stock trading at an incredibly reasonable 1.4 times price-to-book value, a massive cash yield, and management that has just signaled they believe the stock is cheap by resuming buybacks.
That combination of a value floor, operational growth, and infinite cash optionality is incredibly rare in today's market.
It really is.
If you are looking at this stock, the key takeaway is the target horizon. This is definitively a multi-year hold. You cannot view this asset through the lens of a quarterly swing trade or panic over a 3-month lag against the S&P 500.
No, definitely not.
The true compounding power of these massive operating businesses and the eventual inevitable deployment of that record cash hoard requires immense patience to cut through the short-term noise.
And the legal anxieties surrounding PacifiCorp.
Exactly. And here is a thought to leave you with.
Oy.
Everyone is obsessing over when Abel will fire the elephant gun for a massive acquisition. But what if he doesn't?
What do you mean?
What if the ultimate post-Buffett evolution of this company isn't as a giant equity picker, but rather a transition into the world's largest dividend-paying machine?
Oh, wow.
Right. With nearly $400 billion in cash and limited acquisition targets that actually move the needle, initiating a dividend could fundamentally alter who owns this stock.
It would bring in a massive wave of new institutional income investors.
Exactly. It is a completely different paradigm to watch for. Need emergency cash. MaxLend loans offer short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total costs before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.